Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at BigBear.ai.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. The core story for BigBear.ai right now, it's really not about their current operations.
No, it's about a pivot, a huge one.
Exactly. They're trying to transform from, a traditional systems integrator into a secure generative AI platform leader.
And they're focused squarely on defense and national security.
That's their lane.
And the thing that's really driving all the recent stock movement, the main catalyst, has to be the acquisition news.
Without a doubt. The definitive agreement to acquire Ask Sage for $250 million.
$250 million. For a company this size, that is a massive, massive bet.
It is, and it really speaks to how critical they think this is. Ask Sage isn't just another software company.
No, it's more like a foundational piece of their strategy.
It's a generative AI platform built specifically for the secure distribution of AI models and these agentic capabilities.
AI that can act on its own.
Right. And it's all built for defense and these other highly regulated sectors.
So they're not just buying a product, they're buying a moat, a competitive moat.
Yeah.
What makes it so special in that government space?
It really comes down to one thing, certification. And this is the key. You have to understand this part.
Okay.
Ask Sage is one of the only model-agnostic Gen AI platforms with FedRAMP High accreditation.
FedRAMP High. Okay, let's pause on that.
Yeah.
We hear about government certifications a lot,
Yeah.
but why is that one the real key that unlocks the door?
Because it's the absolute gold standard. It's your ticket to the highest levels of national security.
The most sensitive data.
Exactly. Getting FedRAMP High means years of audits and compliance checks. It proves you can handle the government's most sensitive, unclassified information. If you don't have it, you can't even get a seat at the table.
So they basically bought a multi-year head start on any competitor.
They bought time and guaranteed access. It's a pre-approved key to the government's wallet.
And this isn't just a long-term strategic play. It's supposed to add to growth pretty quickly, right?
Oh, absolutely. The scale they're buying is already there. Ask Sage already supports over 100,000 users.
100,000 users across 16,000 government teams.
Right. But it's the growth rate that has investors so excited. Its annual recurring revenue, the ARR, is expected to hit $25 million in 2025.
Now, $25 million in ARR doesn't sound huge on its own, but what's the context? Where is it coming from?
It's a massive six-fold increase from their 2024 ARR.
6 times. Wow.
That's the injection of growth that the company desperately needs. The whole idea is to shift from that low-margin integration work to this high-margin, scalable software revenue.
And that could completely change their financial profile over the next couple of years.
Yeah, it's the hope.
And they're not just sticking to the U.S. government, which is smart. I saw some notes about international expansion.
That's right. They're taking their defense-grade AI stack and aiming it at allied markets. They just opened a new office in the UAE.
Targeting global security needs there.
And even more interesting is this partnership in Malaysia. They're developing Southeast Asia's first AI-driven aerospace hub.
So they're taking their core skills and replicating them abroad, where defense spending is also picking up.
Exactly. So the story, the catalyst narrative, it's very compelling. You've got the security moat, the six-fold ARR growth, global expansion.
That's the bull case.
Mm-hmm.
But let's hit the brakes for a second and look at the actual numbers they just reported, because the Q3 report was confusing.
It was very mixed. I mean, if you just glance at the revenue, it looks okay. $33.1 million. It even beat the consensus estimate by a little bit.
But the problem is what that number means compared to last year.
Right. That same $33.1 million is a 20% decline year over year.
Ouch. A 20% contraction for a company trying to sell a high-growth AI story.
Yeah.
That's a huge red flag. What happened?
It shows they're still fundamentally a government contractor. They live and die by those long, unpredictable contracting cycles.
And the cycles weren't in their favor this quarter.
The decline was mostly due to lower volume on some U.S. Army programs and just timing issues with new contracts. When the government slows down procurement, their top line gets hit instantly.
Which brings us to the biggest, let's say, head-scratcher in the report. They reported a GAAP net income, a profit of $2.5 million.
Right, which sounds fantastic, like a huge turnaround from all the previous losses.
So is profitability finally here?
Unfortunately, no. Not from the core business, anyway. This is where you have to read the fine print.
There's always fine print.
That 2.5 million in profit was almost entirely driven by a huge non-cash gain of 26.1 million.
Non-cash gain. Can you break that down? What does that mean for their actual operational health?
Sure, think of it this way. They didn't earn that money selling their products or services. It was a one-time accounting adjustment.
An accounting victory, not an operational one.
Exactly. It's related to how they value certain derivatives on their balance sheet. It improves their net worth on paper, but it doesn't mean their actual business is making more money.
So if we strip out that one-time paper gain and look at how the business actually performed, what's the reality?
The reality is they're still burning cash. Their adjusted EBITDA was a negative 9.4 million.
Which is actually worse than last year when it was positive.
It is worse, and you see the pressure in their spending. SG&A costs jumped way up, and their gross margin actually shrank.
Down to 22.4%.
Right, so they still have the thin margins of a systems integrator, even while they're spending a ton to become a software company.
So what's the guidance? What is management saying about the future, given these numbers?
Well, they maintained their full-year revenue guidance for 2025 between 125 and 140 million. But the really crucial thing is what analysts are projecting for 2026.
And that is?
A massive 30.2% revenue rebound in 2026.
A 30% jump. It's huge, but it's completely based on assumptions, isn't it?
It's entirely contingent. It depends on those delayed government programs coming through, and more importantly, the super fast, successful integration of Ask Sage.
It has to deliver that high-margin ARR growth and fast.
The whole investment thesis right now is a 2026 story.
Which brings us to the other side of the coin. The counterweight to all these operational losses is their liquidity.
This is maybe the most important stabilizing factor here. Their balance sheet is a fortress.
How much cash do they have?
They ended Q3 with a record $715 million in cash and investments. After you account for debt, they have a net positive cash position of nearly $575 million.
$575 million. That is an enormous war chest.
It's huge. It means they can absorb more delays, they can complete the Ask Sage acquisition, and keep investing without needing to go back to the markets for more money.
How did they build that up?
Through at-the-market equity offerings. They sold shares. It's dilutive to current shareholders, for sure.
But it gets rid of any near-term financing risk.
Completely. They traded some potential future earnings per share for ironclad stability right now.
Okay, so let's shift from stability to the complete opposite. The extreme volatility of this stock. It's a real roller coaster.
It is. It has a beta of around 3.4, so it moves more than 3 times as much as the overall market.
But some of the recent moves, especially the big drop after the good news, some people are saying that was more than just volatility.
Yeah, there are market observers who allege that the drop was a calculated algorithmic attack, a classic sell the news operation.
A calculated attack. What does that playbook even look like?
Well, it starts when the good news hits. The acquisition is announced. Retail investors get excited. They rush in with FOMO.
Pushing the price up to, say, over $6.
Right. And that retail buying frenzy creates the perfect cover for institutions and insiders.
Cover to do what? To sell.
Exactly, to sell. There were notes that insiders filed a Form 144, that's a notice of intent to sell restricted shares, right before the hype peaked.
So they allegedly used that retail buying to unload their shares and at the same time open up huge short positions.
They shorted into the strength, creating this massive wall of selling pressure that retail just couldn't break through.
But if these big institutions are selling that much, how do they keep from crashing the price on themselves immediately?
This is where things get dark. Literally, they use private exchanges called dark pools.
And the allegation is that a huge amount of the trading happened there.
A huge amount, over 33% of the entire day's volume.
A third of all trades happen off exchange, in secret.
In secret. It lets them execute these massive trades without tipping off the public market right away. It's a way to stealthily suppress the price.
So what was the goal? Why force the price down so hard?
It's called liquidity harvesting. The goal was to break a key support level, in this case, $5.50.
Because a lot of retail traders put their stop-loss orders right below that.
Exactly. You break that level, you trigger a cascade of automated selling from all those stop losses, the price collapses, and the institutions that started it all can cover their short positions at a huge discount. They basically steal the shares.
That's a pretty cynical view of the market, but it does make you think. Now, we have to talk about the big comparison everyone makes. Palantir. Is BigBear.ai the next Palantir?
The short answer, just based on the numbers, is no, not yet. Anyway, the comparison makes sense because they're both in that AI for defense niche.
But the differences are just massive.
Let's start with scale. Big Bear's Q3 revenue was $33 million. Palantir's was $1.18 billion.
And Palantir's market cap is what, 140 times bigger?
Something like that. But the more important difference, I think, is the margin profile. Big Bear's gross margin is around 22%. That's a government contractor's margin.
And Palantir's is in the 80s.
Exactly. And that's the difference between a systems integrator model, which requires a lot of labor, and a true scalable software model. Big Bear hopes Ask Sage gets them there, but they have a long way to go.
And BigBear still has a huge customer concentration problem.
It's their biggest vulnerability. 4 major clients make up 52% of their revenue. If one of those has a delay, like the Army program did, their whole business suffers.
Whereas Palantir has diversified so much into the commercial sector.
Right, their U.S. commercial business is surging. It makes them way more resilient to swings in the federal budget.
Okay, so let's put it all together. What's the final risk assessment here?
Well, you have to start with valuation. Even after the drop, the stock is trading at a forward price-to-sales ratio of maybe 13 to 16 times its 2026 estimate.
Which is really high for a low-margin company with shrinking revenue.
It's what some would call an absurd valuation, unless that 2026 rebound happens perfectly.
But there's always the other side. The institutions who are buying this see something else.
They do. You see firms like Jump Financial buying up over 5 million shares. They're positioning for what they see as asymmetric upside.
You're betting the cash on the balance sheet plus the strategic value of Ask Sage will eventually justify that high price tag.
They're betting on the 2026 story.
It really is a fascinating trade-off. You've got this incredibly volatile stock, low operating margins, high contract risk.
But it's all backstopped by that massive $575 million war chest and this one truly strategic acquisition that could change everything.
So I guess the final thought for you to consider is this. If the whole bull case is built on the company's role in national security and defense spending, how do you factor in geopolitics?
Exactly. How do you price in the risk of budget cuts or procurement delays or even a change in administration when you're looking at that 2026 revenue rebound? That's the real challenge here. If you found this breakdown useful, please make sure to subscribe so you never miss a daily analysis and catalyst talk from Smart Wealth with Joshua.